The 1031 exchange lets you sell, trade, and reinvest properties to defer taxes until later. If you pay less in taxes, you can use that extra money to buy more properties, which is exactly how the rich keep getting richer. And in this video, we're going to discuss what a 1031 exchange is, why it's important, some of the pros and cons, plus a couple of alternatives that could work out just for you. And if you're new here, I'm Dr. Jeff Anzalone, a periodontist that's on a mission to get you out of the rat race. I've put together a free passive income guide, which you can grab with the link below this video. Let's get going. So you're probably thinking 1031 exchange. What exactly is a 1031 exchange? Well, this is a way for investors to actually defer paying capital gains taxes on the sale of a property until they buy a new one. This exchange actually goes back to a part of the Revenue Act of 1921 that allowed farmers to put off paying taxes on the sale of their land if they used the money to buy another farm. Then in 1954, this rule was changed so that it applied to all types of real property, and as you can imagine, it's become very popular since then. Let's break this down a little bit and talk about the different time frames. There's a specific time frames that the IRS wants you to go through to make sure this is done correctly. All right. Step number one. The first step is that you sell a property and you buy what's called a like kind replacement property of the same or higher value. Okay. So you're selling a property, you're replacing it with something that has the same value or it's more than it. And then step number two, within 45 days of selling your property, you've got to identify up to 3 properties to replace it with. All right. Step number 3, you actually have 180 days to close. You have 180 days to buy one or more of the properties that you listed up here in step 2. Step number 4, you've got to use what's called a qualified intermediary to help you with this process and to handle the money from the sale of the first property. And then this qualified intermediary, they actually will wire the capital gains to the title company, the holder company, whatever. So those are sort of the steps that you take. We'll actually break this down into, there's 3 key dates that you really need to focus on, all right? And the first one being the sale date. So the investor, they sell the property, and this is generally known as the relinquished property on the sale date. So the sales closing date actually signals the beginning of the time frame. You know, this process that we just talked about, it signals the beginning that this happens and when this person must find a potential replacement property. All right. The sale date, boom, it's sold. That's basically when the stop clock starts. Number 2 was that, remember this 45-day period, the identification period. So you've got 45 days after selling a property that you've got to be able to find a suitable replacement property that actually satisfies a couple of requirements. The first one, remember we talked about, it's got to be a like kind property to the one that was relinquished. Now, what this means is that most commercial properties are actually comparable to other commercial properties, but a primary residence and vacation homes are usually not eligible except in very rare cases. Now, the replacement property's valuation, debt, and equity must match or be of greater value than the one that it's going to be given up for. So for example, if you've got somebody that's selling a $500,000 property with $250,000 in debt, then what this means is the new property must actually have a fair market value of at least $500,000 and at least $250,000 in debt. Now, investors may designate up to 3 potential replacement properties, and if they close on at least one of them or any number of replacement properties, provided that the aggregate value of the assets does not exceed 200% of the value of the property being surrendered. The replacement investment properties must be legally specified in writing with their legal description by the qualified intermediary. Now, due to these requirements, finding a substitute property within the 45-day period sometimes can be difficult. And then the third key date, what we talked about, was this 180-day period. Now, property owners have 180 days from the day The surrendered property was sold to close on the purchase of the replacement property. In other words, you have an additional 135 days, because remember you had 45 days uh, initially to ID, so you have an additional 135 days from the time the replacement property is identified to complete your purchase. Now, given that it includes performing some due diligence and then you've got to get it financed, again, sometimes this time frame is relatively quick. Now, let's break it down into a few of the pros and cons. Let's start off with the pros first. And the main pro of 1031 exchange is you get to defer your capital gains. So when investors use this process, they can defer their gains on the sale of a property and instead use the entire profit to buy another property. Now think about this. Wealth can be built much faster in this process. Just think about if you repeat this over and over again throughout your lifetime. All right. That's the first pro. The second pro is you get to reset depreciation. Now, investors can write off the depreciation of their properties to offset the wear and tear and the aging of the property that they bought. The IRS actually allows for a depreciable period of 27 and a half years for residential properties, meaning that the value of the building can be deducted from taxable income on an annual basis over that 27 and a half years. But property improvements might not be fully considered in the depreciation calculations if the property is not reassessed when it's sold. So a 1031 exchange offers a possibility of actually resetting the depreciation amount of a property to a higher value, providing a larger tax benefit on an annual basis. And the third pro of a 1031 exchange is you get to defer taxes until you pass away. So a continuous 1031 exchange strategy allows you to actually swap properties and avoid paying taxes until you expire, basically. And once this happens, the properties can be passed on to your relatives without them having to pay the accumulated capital gains taxes. Instead, they will inherit the properties in what's called a step-up basis, meaning that they'll inherit them at the current fair market value price whenever you pass away. Now, this is an excellent strategy for people to accumulate generational wealth. This is what the really, really wealthy people do for their families over time. Now, those are the pros. So anything that's got some pros, they're always probably going to have some cons. So the first cons of a 1031 exchange is the capital gains are not accessible. So you won't be able to access the capital gains on the sale of your property using a 1031 exchange because they've got to be, remember, added to your future investment. So for example, if you wanted to invest $200,000 that you made from the sale of, let's say, a self-storage facility into something else, let's say like a dividend stock, then you would lose the exchange's protection and you would have to pay taxes on the gain. Okay. Number two, the entire investment, it must be rolled over. So let's continue with the example we just talked about with the self-storage. So with an annual cost of $800,000, okay, so we have an annual cost of $800,000, excuse me, an initial cost of $800,000, and then we're going to say it's got a $200,000 profit. All right. So remember, the entire investment amount must be rolled over. So when you use a 1031 exchange, you must roll over this entire amount. The 800,000 plus the 200,000 is $1 million, not just the profit, not just the capital gains amount, which was $200,000 in this situation. And then the third con would be that the way that it's structured. So if more than one person is actually investing in a project, it could actually make performing this 1031 exchange a little bit more complicated. So for example, if 4 investors each own 25% of a short-term rental and 2 of them want to get their money out, the other 2 investors must either buy them out and roll over 100% of the partnership's initial investment and profits, or they split the partnership and the title holding company into 2 separate companies, one that's actually rolling over the funds and the other that's actually liquidating. As you can tell, this could get a little bit complicated, so make sure that you've got, if this is something that you're going to be doing with other people, make sure you have a good team, specifically a real estate an attorney that's part of your counsel. So when should you consider doing a 1031 exchange? Now, one, if you're looking to diversify your portfolio, if you've got a property with actually higher returns that's been identified, maybe if you can make more money, you should consider this. If you want to combine several properties into one, or divide a single property into several assets, and if you want to reset the depreciation clock to zero, like we talked about just a few minutes ago. Remember, the whole point of utilizing a 1031 exchange versus just selling a property and buying another one is that tax deferral. That's the whole point that you're doing this. So if you're in a situation wanting to defer capital gains tax, and this method is going to allow you to invest more capital into the replacement property. Now, understanding the full benefits of a 1031 exchange also requires understanding of depreciation. Now, depreciation is the percentage of investment's property's cost that's actually written off each year due to the wear and tear of the property. After you sell a property, capital gains tax are calculated using the property's net adjusted basis, which is the original purchase price plus any capital improvements minus depreciation. So you've got the original purchase price, then you've got the money that you put in to improve the property, then you subtract out the depreciation. All right, so that's how the capital gains taxes are calculated. Now, if you sell a property for more than its depreciated value, you may be required to recoup the depreciation by something called depreciation recapture. This means the depreciation will be included in your taxable income from the sale of the property. And since the amount of depreciation recapture actually goes up over time, this could motivate you to do a 1031 exchange to avoid a huge increase in your taxable income that would come from potentially the depreciation recapture. Now, because the 1031 exchange time frame, again, can be a very tight window, and some investors may not have time to buy a property or a whole property, there's actually two fractional ownership options that you could consider. The first one is something called a DST, or a Delaware Statutory Trust. This is legally recognized. It's a legally recognized trust. It was actually set up for purposes of business purposes, but not necessarily in Delaware. So multiple investors, they pool their money into a DST, and each one of them owns a fractional share of a trust, which in turn owns a property. Ownership in a DST is proportionate to the amount invested by each investor, which are deemed as beneficiaries of the trust. The IRS treats DST interest as direct property ownership. Thus, you qualify for a 1031 exchange and other tax benefits. And the second alternative is something called a TIC, or a tenants in common. Now, this particular ownership structure is in which two or more parties share ownership rights in a piece of real estate. Each owner may control an equal or different percentage of the total property, and the parties are referred to as tenants in common. This can apply to both residential and commercial property. Now, both of these choices, DSTs and TICs, they may be utilized as replacement properties in a 1031 exchange in accordance with the IRS regulations and property identification laws. Remember, if you're going to do this, make sure you've got somebody to help you with the legal ramifications, particularly a real estate attorney. So remember, there are three crucial dates to keep in mind when you're doing the 1031 exchange. The relinquished property's sale date is the first. Now, since it starts the countdown for all subsequent deadlines in the transaction, you want to treat this as day 0. That starts the clock. Now, second, you've got to identify your replacement property by day 45, and the identification must adhere to a set of regulations governing the cost of the intended use. And then the last date, remember, is day 180, which is when you've got to complete the purchase of the identified property or properties. Now, if you're interested in continuing to learn the process about lowering your taxes, because if you don't take it upon yourself to do so, you're going to continue to pay a lot of taxes. So if you want to continue your learning about reducing your taxes with real estate, I've got another video just for you of the 7 best real estate tax strategies right over here. I'll catch you over there.